Right, no fluff. Let's get straight to it. We're talking volatility regimes today. Sounds like some, I don't know, nerdy CMT level 2 textbook rubbish, but honestly, if you don't get this,
Right.
you're basically trading with a blindfold on. Morgan, you love your slow-mo stocks. What's your angle on it?
Slow-mo? Mate, the FTSE 100 had more drama last month than a season of Love Island. But you're bang on. Volatility regimes are everything. It's the market's personality, and it can flip on a dime. You've got your low vol regime, where everything's chilled. Think of the market just cruising down the motorway,
Yeah.
nice and steady. Then you've got your high vol regime, which is like a madman on a moped weaving through rush hour traffic in the rain.
That's a decent analogy. I mean, in crypto, our low vol is your high vol. Our chilled motorway cruise is still 100 miles per hour.
Wow.
But the principle's the same, right? We get these periods where Bitcoin just crabs sideways for weeks, boring everyone to death.
Right.
Then, bang, one piece of news, and we're in a completely different market
Right.
with 10% daily swings. The key thing, and this is the bit people miss,
Yeah.
is that these moods, these regimes, they stick around.
Exactly. That's the golden nugget, volatility clustering. It's the idea that chaos breeds more chaos and calm breeds more calm.
Okay.
Think of it like a night out. You start with one quiet pint, it leads to another. That's your low vol regime. But the second someone shouts Jaeger bombs, the night's getting messy.
Yeah.
It's going to stay messy for a few hours. That's your high vol regime kicking in. The market doesn't just forget yesterday's drama.
So how do you spot it, before you're down 3 Jaeger bombs and your portfolio's on fire? In my world, it's raw price action. You see the daily candle wicks getting longer, the ATR shooting up, the order book gets thin and gappy. What about in your boomer markets?
We've got the VIX, the fear index.
Right.
It's basically a measure of how scared the market is. Think of it as the bouncer at the club. When the VIX is low, say under 20, the bouncer's leaning back, relaxed.
Okay.
The crowd is calm. When the VIX starts creeping up past 30, he's standing bolt upright, arms crossed.
Yeah.
He's tense. You know trouble is brewing. It's implied volatility.
Ah.
It's forward-looking. It's the market pricing in the chance of a fight breaking out.
Implied versus realized. Okay, so the VIX is the gossip and the rumor, and the actual price swing is the punch being thrown. We have that in crypto options too, with the Deribit Volatility Index, the DVOL. It's crucial because the gap between what people think will happen and what actually happens is where the money is. So let's get practical. How does your strategy change regime to regime?
Massively. In a low-vol regime, I'm a trend-following man.
Okay.
Buy the dip, hold for a bit, use a reasonably tight stop. You can also run range-bound strategies, selling the top of a channel, buying the bottom. It's methodical. But the moment the VIX spikes and we switch to high-vol, that whole playbook goes out the window. How so? Well, first, trend following gets you killed.
Right.
Seriously, the reversals are too violent. It becomes a mean reversion game. You're looking for price to get way overextended, then betting on a snapback. Your stops have to be way wider to accommodate the noise, and your position size has to come right down, of course, or you'll get liquidated. And you take profits quicker. You're not trying to ride a trend for 2 weeks. You're happy to scalp 1% and get out.
That's crypto trading 101, mate. Welcome to our world. During a bull run, we might have a lowish vol grind upward. You can buy a breakout and hold. But when the market flips, like it did in May 2021, you're trading differently. You're looking for those massive liquidation cascades. You're not buying a 10% dip.
No.
Because you know it could easily become a 30% dip.
Let's give them a classic example. Brexit night, 2016. That was a regime change happening in real time. Before the vote, GBP USD was just jittery. The moment the Sunderland result came in, a leave voting area,
Oh, yeah.
the market went into a high volatility meltdown. Cable dropped hundreds of pips in minutes. If you were still running your sleepy little range trading bot from the day before, oof, you got absolutely annihilated.
And you just knew the next day and the day after that.
Yep.
We're going to be wild. That's the clustering. The shock doesn't just disappear. The market has PTSD. It's the same with crypto. One exchange blows up, and for the next 6 months, the market is on a knife's edge. Any rumor, any little bit of FUD, and you get a massive reaction.
So let's talk about the models behind this. You mentioned CMT level 2. They love talking about GIAO. It sounds complicated, but it's just a fancy mathematical way of describing what we've been talking about.
Okay.
It's a model that says, hey, today's volatility is probably going to be a bit like yesterday's. It helps quants and hedge funds build systems that automatically adapt to the regime.
Right, so it's about quantifying the vibe. For most people listening, you don't need to run a Garch model. You can look at Bollinger Bands. In a low-vol regime, they're tight, hugging the price.
Yeah.
That's the Bollinger Band squeeze. It's the market coiling up like a spring. When they suddenly expand wide, that's the high-vol regime. The spring has been released. The classic trade is to wait for the squeeze,
Right.
and then trade the direction of the breakout.
The key is that a breakout from a low-vol squeeze is way more trustworthy than a breakout in an already choppy high-vol market.
Yeah, good point.
In a high-vol regime, you get false breakouts all the time. The market's just shaking people out, shaking liquidity above and below. You have to know the difference.
Absolutely. It's context. So let's nail this down for the listeners. Step 1, identify the regime.
Yep.
Are the bouncers relaxed or tense? Is the VIX or DVOL at 15 or 50?
Step 2, adapt your strategy.
Okay.
Adapt your strategy. Don't be the guy using a trend-following strategy in a ranging market or a tight stop strategy in a hurricane. Low vol loves trends and ranges. High vol loves momentum and mean reversion.
And step 3, and this is the big one,
Go on.
adjust your risk. This is the whole point. In a high-vol regime, you cut your size, full stop. The setups might look juicier, the potential profit bigger,
Right.
but the chance of getting wiped out is 10 times higher. You're there to trade tomorrow, not to gamble it all on one move.
Couldn't have said it better myself. Ignoring volatility regimes is like driving the same speed in glorious sunshine and in a thick fog.
Yeah.
Sooner or later, you're going to crash. Understanding them is what separates the pros from the punters.
It's the closest thing we have to a crystal ball. It doesn't tell you which way the market will go.
No.
It tells you how it's likely to travel, and that's a massive edge.
Right? Food for thought, then. We've talked about how we adapt to these regimes. But markets are reflexive. The strategies people use can influence the market itself.
So here's a question we'd like you to think about. As more and more traders and algorithms become aware of these volatility regimes and use similar strategies to exploit them, could that cause the regimes themselves to change? Could our attempts to predict the storm actually end up changing the weather?
Right.